Hey there, and welcome back to another High School Money Matters video. Today we're going to be going over something that a lot of adults have to figure out at some point in their life: mortgages. By watching this video, hopefully you'll get a little bit more of an idea about what a mortgage is and how they work, and then for a little fun you can quiz the adults in your life and see how much they really know. So what is a mortgage anyway? Well, a mortgage is a loan on a house, or a condo, or a townhouse, anything that has a dwelling on it where somebody's going to be living. That's one of the key determinants for a mortgage. It can't just be on bare land unless there's a plan in place to put a house on that land. Because houses are fairly expensive in most parts of Canada, most people don't have enough money to buy a house outright, so they need to borrow money for the bulk of the purchase. This comes in the form of a mortgage from a bank. Once someone signs up for a mortgage, they then pay that mortgage back in small increments over time. This becomes the mortgage payment, and you maybe pay it monthly or every 2 weeks, whatever you work out with your lender. In exchange for giving you the mortgage, in order to secure that loan, the bank will register a charge against the property, which means that if you ever fail to pay the mortgage payment, they have the right to take your house and then sell it in order to pay themselves back. Because the mortgage loan is in essence secured by the value of the property, this type of loan is considered very safe by the bank, so in turn they offer one of the lowest interest rates of any bank lending product. Let's take a quick look and see how mortgages work. Most other loans you would get from a bank that are over a shorter period of time, like for a car loan or some other large purchase, would be set up at the beginning, maybe 4 or 5 years, and you would determine the interest rate and the payback period over that time. Because a mortgage is generally much bigger, it's usually spread out over 25 or 30 years, and then it's split up into terms. And during each term, you will renegotiate different aspects of the mortgage, from the interest rate to how you like to pay it back. Now, there are many different types of mortgage terms that borrowers can choose from. In this video, we're just going to go over the 3 most common features that people tend to choose between. These 3 mortgage features are the length of the term, whether it's an open or closed mortgage, and a fixed versus variable interest rate. The length of the term. It's usually between 1 and 5 years, although it can be longer, and it's the contractual amount of time that the borrower is required to pay the loan back over. Now, the term is different than the amortization. Even when a 5-year term is up, there may still be another 20 years in amortization left on the mortgage, but after that 5 years, the borrower can renegotiate the specifics of the mortgage. They can change the interest rate, they can change the way that they pay it, and all of those sorts of things. And when speaking about the length of term, generally the shorter the term, the lower the interest rate. Because if you pick a long term, the bank has to hedge its bets around interest rates going up or down, and so they're going to charge you a slightly higher rate for a longer term mortgage. The type of term, whether it's open or closed. An open mortgage means that the borrower can renegotiate the terms of that mortgage whenever they like. They can change it if the interest rates change, or if they want to change their payment amount or payment frequency. The mortgage is open and flexible. A closed mortgage means that the borrower has to abide by the details of that mortgage for that term length. So if they have a 5-year closed mortgage, then for those 5 years, they have to make those payments in that amount and will be charged whatever the interest rate was over that period of time. And they may be charged a penalty if they want to try to renegotiate the mortgage before the term is up. In this case, closed mortgages tend to have a slightly lower interest rate because of the reduced flexibility. The banks offer a lower rate because they can guarantee the income that they're going to make off that mortgage for a longer period of time as compared to an open mortgage. And finally, fixed versus variable interest rates. Now, this may be one of the biggest decisions you make as a borrower. And it's one of those decisions that really comes down to personal comfort. Would you like an interest rate that is fixed for the entire term of your mortgage so that it's predictable, you know what your payments will be, you know how much of each payment is going towards principal and interest, and you know exactly how much you'll have remaining owing on your mortgage at the end of the term? If you have a variable interest rate, then the payments can fluctuate and the amount that goes towards principal and interest can also fluctuate depending on what the prime lending rate is at the bank. Fixed rates are set at the beginning of the term of the mortgage and remain the same for that entire term. It makes the payments very predictable, they stay the same, and the amount going towards principal and interest remain the same. With a variable rate, the interest rates can fluctuate, which will change how much of each payment is going towards principal and interest. Now, if the rates rise too much, this can now impact your payment. You could potentially have to actually increase your monthly payment just to cover the interest costs. On the flip side, if the interest rates go down, you get to take advantage of that savings instantly because your rate goes down as the prime rate moves down. Whereas someone with a fixed rate mortgage is locked into that rate and doesn't get to take advantage of interest rates going down. What it comes down to is this. The pros for a fixed interest rate are that they're very predictable, the payments stay the same, and they're not susceptible to interest rate increases. The cons are that they generally have a higher initial interest rate and they don't get to take advantage of interest rate drops. With a variable rate mortgage, the pros are that they have a lower initial interest rate and that you can take advantage of the interest rate decreases. The cons are that if the interest rates rise, more of your payment is going to be going towards paying interest, and if they rise too much, you might actually have to increase your payment just to be able to cover the interest costs. Confusing, right? Let's do a few examples so that you can sort of visualize what we're talking about. Let's say customer A opts for a $400,000 mortgage. Because they're worried about interest rates fluctuating, they opt for a fixed rate mortgage at 3.5%. With just these numbers, we can use any of the online mortgage calculators that are offered by the Canadian banks to figure out what the payments will be, as well as what the interest charges will be over the term of the mortgage. Let's take a look. So with those numbers, this mortgage calculator shows us that the payments will be around $2,000 per month. This is a 5-year term, so it's going to be 60 months altogether. 5 years times 12 months equals 60 payments. $2,000 times those 60 payments gives us $120,000. This is how much our borrower will be paying toward their mortgage over that 5-year period. Of that $120,000 that the customer pays in mortgage payments, we can see that just around $65,000 of that will be interest, and we can do a subtraction to find out that $55,000 will go towards paying down the principal. It's all very predictable with a fixed rate mortgage. Now let's take a look at customer B. Customer B also borrows $400,000, but instead opts for a variable rate mortgage of prime minus 0.5%. The current prime lending rate is 3%, so customer B gets a starting rate of around 2.5%. Their payments are only $1,800 a month, about $200 less than the fixed rate mortgage. And if the rate stays the same over that entire 5-year term, their interest costs for the period are around $46,000, nearly $20,000 less than the fixed term mortgage. So this sounds great, right? It sounds like we'd save a lot of money if we just choose a variable rate mortgage, but it is a variable rate. And so what happens if the interest rate changes after the first year? Let's say it goes up by 1% per year for the following 2 years and then stays stable. So in this scenario, we would pay our starting rate of 2.5% for the first year, which would cost us $9,000 in interest. Then we would pay 3.5% for the second year, which would cost us $13,000 in interest, and 4.5% for the next 3 years, costing us $17,000 per year for those years, for a total of $73,000 in interest, nearly $10,000 more than the fixed rate 5-year that we looked at in the previous scenario. So which is the best option, fixed or variable? Well, there isn't really a best option. It really comes down to the amount of risk you're prepared to tolerate. If you feel that interest rates will stay stable or even decrease in the future, then you're probably better off with a variable rate. But if you really need to have the peace of mind of knowing how much your mortgage payments are going to be over the next 5 years and knowing exactly how much of your mortgage you will have paid off in that time, then perhaps a fixed rate is for you. You really have to just weigh your options and then make a decision. So one typical mortgage customer may choose a 5-year closed fixed rate mortgage because they really want the predictability of knowing exactly how much their mortgage payment is going to be and exactly how much they'll have paid off by the end of the term. Another equally typical mortgage customer may choose a 5-year closed variable rate mortgage because they feel that rates are going to either stay the same or drop in the near future, and they want to be able to take advantage of those lowering interest rates. A third customer may choose a 3-year open variable mortgage because they're thinking of selling their house in the future and they need to have an open mortgage because they need the flexibility of being to pay it off whenever they want, whenever a sale may go through. All of these options are perfectly fine depending on the situation and depending on the person. Mortgages are complicated financial instruments, and banks do their best to explain them to their clients, but sometimes people don't really get it. And this is partially what led to the 2008 subprime mortgage fiasco in the US, where banks were bringing customers into mortgage products that they didn't really fully understand. So when looking for a mortgage, do some research. Talk to your friends, talk to your bank or more than one bank, do a little bit of experimenting with the online mortgage calculators to kind of see how they work. The more information and knowledge you can go into your mortgage appointment with, the better you'll feel about the decision that you ultimately make. Hope you enjoyed this video. On to the next one.